Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following out of the BNN Bloomberg newsroom. Shares of Royal Bank of Canada edging higher, with the lender beating estimates in its latest quarter. It was driven by strength in capital markets and wealth management. RBC also saw strong results in its personal and commercial banking segments. The lender also boosted its quarterly dividend by 6%. National Bank of Canada also beat analyst estimates on net income and revenue for its fourth quarter. The Montreal-based lender also posted better than expected results for capital markets. It missed forecasts in the previous quarter on that. The firm is set to take over Laurentian Bank's retail and small business assets. The Parliamentary Budget Officer says federal spending on housing is projected to drop by more than half over the next 3 years. It's set to decline to $4 billion in 2028-29, down from $9 billion in the current fiscal year. Various housing programs are set to expire, but the PBO notes government departments could decide to extend them. Hiring at U.S. companies has dropped the most since 2023. This is coming from ADP National Employment Report. In November, private sector payrolls decreased by 32,000. It comes after private employers added 42,000 jobs in October. The recent weak numbers risk increasing concerns of a more rapid deterioration in the labor market ahead of the Federal Reserve's meeting next week. Here's where we stand right now on the North American markets. The TSX, a gain of 93 points on the day to 31,142. Let's go south of the border. The S&P 500, a 28-point gain right now. The Dow Jones, a 458-point move up, almost a full percent. And the Nasdaq gaining 75 or 76 points, up about 1/3%. The big Canadian banks are reporting this week. Royal and National releasing their reports ahead of the trading day. Let's dig in the numbers with Kyle Taylor. He's wealth advisor and portfolio manager at Tri-Delta Private Wealth. Thanks for joining us today.
Thank you.
Solid earnings from both of the banks, but let's start with Royal, which reported $5.4 billion in profit for its latest quarter. Capital markets doing well. And Kyle, that's really no surprise.
Yeah, I can't say we were expecting any surprises, significantly for RBC or any of the banks this week. I think it's good for the TSX, generally speaking, that we're not seeing any surprises. But one of the things that we were watching pretty much across the board was really just any comments around provisions for credit losses. You may remember that earlier in the year, and due to tariffs, they increased provisions for credit losses kind of across the board. RBC was no different. And then, as they saw that loans were continuing to perform, they reduced those provisions, which saw a lot of momentum for the financial stocks, sort of driving up for most of the year. And now we're starting to see those provisionings creep higher. And I don't think that's really any surprise given some of the economic data and genuine fears for the consumer.
Okay, so talk to me about wealth management being strong for both banks. Royal, we'll start there.
Well, I can't say it comes as much surprise for RBC. They were up 33% year over year. As that asset base expands and they continue to take on more Canadians as clients, they're going to generate more fees in that respect. But I think just as quickly as that can happen in a good year like 2025, who knows what 2026 has ahead in terms of how market performance and what they're going to see in that particular segment.
The CEO is giving a conservative push for the forecast. Do you think he needs to be or err on the side of caution at this point?
I certainly do. I think that it's no secret that everyone's sort of a little bit more cautious headed into 2026. Broadly speaking, even just outside of the banks, I think 2025 has been one of the most hated rallies in recent memory that we can really point to, and we're seeing the same comments come out from CEOs and not just the banks, but broadly speaking as well.
All right, let's get to National. Strength in the same unit, capital markets, wealth management. But how has it managed its Western acquisition? How's that going?
Well, expenses, no doubt, were increased. I believe it was about 21%, and that offset some of the profitability that they saw in other segments. But I think generally speaking, it's been a good integration. I think it helps them increase their market share and also gain a bit more of a foothold outside of Quebec. And then of course we had the big news earlier this week with Laurentian Bank and Fairstone, and the deals being split between Fairstone and National Bank, and National Bank taking the deposits in some of the SME loans. That should be accretive to return on equity by, I think we estimate by about 2%. Generally speaking, though, I think we see National Bank as pretty fairly valued today in and around the high 160s, low 170s. And there's kind of limited room for upside on them. But again, there could be some surprises in respect to the integration of Laurentian Bank and further increase in market share from CWB.
What do you expect from that integration? I don't think National will oversee the closures of the banks in Quebec.
I think it incrementally strengthens their presence in Quebec, which is of course their core market. And it seems that especially in particular yesterday, it was generally well received. Today, I think we're seeing a little bit of a normalization. Earnings really weren't a surprise, and maybe investors felt that the stock got a little high yesterday, and we're seeing a bit of a pullback today.
Okay, let me ask you about the banks and what we've seen so far in reporting, and whether you think it paints a fair picture of what the Canadian economy looks like today.
That's the question, right? It's interesting because, of course, the banks seem to be trading at a premium in the face of significant economic weakness. I really fail to see how the banks can make a material move higher into 2026, but that doesn't mean that earnings can't catch up to multiples if the economy and consumer prove resilient into 2026, 2027. 2026 is another big year for mortgage renewals for Canadians, which will be of acute focus. There's a lot of things on the macro as well, the USMCA renegotiation with Canada, the US, and Mexico that could shift outlooks pretty dramatically. And then, generally speaking, though, I think if we only see a marginal decrease in interest rates from the Bank of Canada in 2026, that still leaves plenty of room for profitability from the banks. I think where the outlook takes a dramatic shift is if we see a swing to that one way or the other in interest rates and how some of the implications for that more broadly.
Do you feel like the lack of a trade deal or a renegotiation on the trade deal is a big overhang for the banks?
I think it's a big overhang for everybody, not just the banks. I think the TSX in general. The one aspect that I can maybe be proven wrong a little bit on the TSX and the bank stocks is if we start to see, as a Canadian market, if we start to see a bit more of the incremental fund flows from international investors. It's no secret that we're seeing a bit of a rotation out of US dollar assets and away from that expensive market to other regions. I mean, Canada is a significantly smaller market than the U.S., and if we saw even 0.5% of those fund flows, that can move the needle in Canada, and the banks being a significant portion of our index, that can help push things quite a bit higher and stretch multiples even further.
Kyle Taylor, I'm going to leave it there. I'm out of time. Thanks for your time. Appreciate it.
Thank you.
Straight ahead, new forecasts show Canada is expected to build only 26,000 homes over the next 5 years. We'll break that down in a moment. Federal spending on housing is expected to decline by more than half over the next 3 years. That's if current programs don't get renewed. So this is coming from Canada's parliamentary budget officer. We got insight from the interim officer, Jason Jacques.
On our end, we're working with the data, the public data published by the government as part of their short-term planning, their longer-term planning. And of course, we're looking as well at information that was shared with us by the Department of Finance around Budget 2025, which shows about a 56% decline in federal spending on housing. There might be subsequent decisions made over the next 3 years, but I think as most people realize, if the public numbers are forecasting some sort of decline, there could be an offset, but you got to go with what you see right now.
So I'm curious, how do you circle the square here between what seems to be an oversupply based on pricing that was, most likely outdated, and a shortage of new homes that really, where I guess the public at large really needs more affordability. How do you bring those two forces together from here? Because it seems like we do have a bit of a mismatch. In terms of
oh, sorry. Go ahead.
No, just
no, I
in
was going to
terms.
say it's a really good question, and I think there are two things going on. And the first one, I think you hit the nail on the head in terms of the homes that, for people who are actually looking to get into their first home, the homes that they're looking to buy, the supply of those homes on the market, there isn't necessarily the supply of those homes in the market. So within various markets across the country, the people that are looking to move from renting into buying their first home, or looking for a rental to rent something, there isn't the supply there that they would necessarily need and look for. The other thing to keep in mind is there are effectively 16 distinct regions or housing regions across the country. So while Toronto obviously has a really big weight alongside Vancouver and the other major metropolitan areas, there are 16 distinct regions. So even if there is an oversupply in the case of Toronto, not everybody's going to move to Toronto, and obviously you can't take the housing supply from Toronto and shift it out to Montreal.
So do you think at the end of the day, the federal government's going to make money on this program? Is the goal here to stay neutral, or is this basically like a subsidy just to help the average Canadian out?
I think in terms of most government programmings, obviously it's the public sector. So the government is not getting into it to make money. That's why we have the private sector, and that's why we have capitalism. That said, there is a good part, especially on the Build Canada Homes side, a big part of the funding, which is offering loan guarantees and concessionary loans, which could provide some sort of revenue back to the federal government, potentially to sustain the program and sustain the organization. But obviously, with most government programs, one would expect that there's going to need to be some sort of ongoing federal support to keep these programs in place.
And now you mentioned about getting the private sector involved. It's with everything that's unfolding within the housing market right now, there doesn't seem to be an appetite. How do you convince them that to get involved and it's worth it to them?
Well, obviously, we're not experts in that specific area. We did look in detail at what the government's doing around Build Canada Homes, and I think looking at the structure of the new organization, it is pretty instructive, because it isn't simply a question of the federal government cutting a check to somebody and kind of hoping for the best. It is more of a comprehensive approach where you do have a suite of financial supports that are offered to private sector developers. In addition to that, focusing on the federal assets themselves and looking at opportunities for conversion. And last but not least, something that Build Canada Homes itself isn't looking at, but the government has indicated within the housing sector it's looking at, is on the regulatory side. So both if things can be simplified at the federal level, and in addition to that, especially as part of the Housing Accelerator program, leaning on municipalities across the country to try to streamline regulation to make sure that, the regulatory burden on developers or on the private sector, when they want to go in and build something, it's a lot lower. So that both saves time, which is money, it also saves money, and it also provides certainty, right? So if you're looking at a 24, 48-month cycle where you need to go obtain the financing, get the land in place, line up the potential buyers, and start to make those investments, there's additional certainty in place. So the math in the spreadsheets works out.
So if you're at the helm and you're able to influence 100% of policy here, what would your projection be in 5 years? Where would we be at with this program in terms of new housing?
On our end, within the Parliamentary Budget Office, we don't do policy. We only do numbers.
Sure.
So effectively, we're the referees. So we're the folks that are supposed to look at the numbers and look at the spreadsheets presented by the government around their policy plans and say, okay, in reality, this is what cold, impartial analysis would tell you, as opposed to the thousands of comms people who work in government are going to tell you with the glossy brochures and the nice websites. The numbers that we're looking at this point, based upon the historical track record of the government, indicate that there's probably going to be about 26,000 units created over the next 5 years in Build Canada Homes. The government has a higher number, and I think from the government side, their argument is what they're trying to do with Build Canada Homes is, I think they've used the word transformative. Certainly from our perspective, it very well might be transformative. What we look at is what's the government's track record. Similar to, I guess, what your audience is familiar with. If there's a company, publicly traded company that's out there, they have a track record, you know what the return on equity is, you know how effectively they can execute on plans. If that company comes out with a press release and says, you know what, don't pay attention to what we've done in the past, focus on the transformative element of what we're doing in the future, for which we don't necessarily have a track record, potentially it's something you might want to pay attention to. Potentially the numbers might be a lot higher than the 26,000 we've come up with at this point. And at the same time, there's the weight of history that the government obviously has to deal with. And again, 26,000, it's not nothing. So we've, as you mentioned at the outset, we've indicated the government, there's a gap of about 65,000 homes and builds that need to happen every single year for the next 10 years to restore affordability. So if we're looking at an additional 5,000 a year over the next 5 years, it's definitely a step in the right direction.
Jason Jacques, Interim Parliamentary Budget Officer. Coming up next, Canada has secured a deal to join Europe's defense procurement program. We'll tell you how that could benefit Canadian companies when we come back. Canada will join the European Defence Fund. It means Canadian defence firms will have access to both funds and expertise to develop their lines of business. Let's bring in John Manley on this, former Deputy Prime Minister and Finance Minister of Canada, Chair of Jefferies Securities. Thanks for joining us today.
My pleasure. Thank you.
What would you say is the purpose of the European Defence Fund first?
Well, first, I think what the Europeans have realized, as Canada has, is that the world has become a much more dangerous place. This is part of a cooperative initiative on the part of the Europeans, some of whom are not NATO members, to build defense capability for Europe and to do so more efficiently and effectively than they've done in the past. So for Canada to actually get into this is quite monumental. And there are many ways we're like the Europeans, but we're not in Europe. So this is quite an important transaction for us.
On that note, the UK did try to join. That ended without an agreement. How do you think Canada managed to secure a deal?
We don't have some of the history with the continent that Britain has. We also have perhaps a different perspective on it. I think this is one piece of a much bigger puzzle, some of which has nothing to do with defense, but which has to do with increasing diversity of the Canadian economy and increasing the resilience of the Canadian economy. So undoubtedly, we were prepared to make an effort that was particular to Canada.
Does this also allow Canadian companies to then go to European suppliers, meaning turning away from American suppliers?
Well, you don't need to turn away, but you do have a preferred access to European businesses, and also Canadian defense companies, in addition to cooperating or collaborating with European companies, will have access to European procurement directly. So we haven't put a lot of effort broadly into our defense industry over the last number of decades. We've got a number of companies that are growing and are important in that field. You think of CAE in Montreal, MDA largely in Toronto now. They've done other things, but they've had some defense role. Those will increase now. I think it's an important time for Canada to pivot, regrettably, because it means that we actually need the products and services that these companies can provide.
Okay, so we do have some defense companies. Do you think we could have some startup defense companies from Europe sort of moving over to have some headquarters here or open offices or manufacturing facilities in Canada? Could it work that way?
Well, there'll be two things that happen. One is that, yes, to the extent that they're supplying Canadian needs under Canadian defense procurement, you'll see them urged by the Canadian government to establish some facilities, build some capability in Canada. You've already seen that debate going on with respect to fighter aircraft, where Saab very much would like to have the contract and basically says, give us the contract, we'll build them in Canada. The other thing that's going to happen, I think, is that you'll see some pivoting by companies in other sectors toward defense. As an example, if you think about companies that make things, think of the automotive sector, which has been targeted by Trump tariffs, which has been so important to Ontario. I think you can begin to see some of those especially parts manufacturers, begin a pivot toward supplying in the defense sector. They've got the capability, they just haven't had the product lines, nor have they needed them in the past.
And what do you make of this this position Canada's in to buy from the U.S. what it's going now to give to Ukraine? It seems like a workaround. Is that just so the U.S. is getting income from this instead of spending its own money?
Yeah, I think that the president has demonstrated some lack of interest in the degree to which Ukraine requires liberal democracies to support it. And but he's satisfied if others, do it, provide American businesses with sales while supplying Ukraine. That's a win-win as far as he's concerned, or at least it's a single win because of the American jobs that are created by it. But I think that for Canada, we're very conscious of the fact that protecting the integrity of borders is something that's of concern to us. So we're bound to be very much part of the alliance that's supporting Ukraine.
Okay. John Manley, sir, got to leave it there. Thank you for your time. Appreciate it.
My pleasure. Thank you.
Coming up next, closing bells on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the NASDAQ, it's Calamos Investments ringing the bell. In New York, Helios Technology celebrating its 55th anniversary of founding. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite finally moving back into the green today, 111 points up to end of the day at 31,160. The S&P 500, a gain of just 20 points today to 6,850. And the NASDAQ gaining 40 points today to 23,454. Let's get to the movers in Toronto. Miners have been on the move today. Capstone Copper is where we start. It gained over 8% today, or $1, taking shares to $12.96. We'll have more on this story in just a moment. International Petroleum also gaining today. It moved up closer to 8%, 7.74. That's a gain of $2.07 a share. Let's go to Ivanhoe Mines. It moved up 8.5%, gaining $1.23 and taking it to $15.61, but it is in the negative over the past year. And then Curaleaf Holdings, which is a cannabis company, it moved up 4.6% today, 15 cents to $3.39. In the red today is Orla Mining. It dropped over 4%, losing 80 cents to $18.64. And then Aya Gold and Silver also falling today, 3.3%. That's a drop of 65 cents a share. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now with some details. Stephanie, what is moving Capstone Copper?
Yeah, that's right, Marilla. So Capstone Copper was the top performer on the TSX for pretty much the entire trading day today, moving 9% higher, which gave the stock its best day in about 2 months. And it's rising in tandem with other copper names after futures of the red metal hit a record high recently, just driven by fears of a supply squeeze caused by U.S. tariffs. So that led to more copper orders being withdrawn from the London Metal Exchange. And it seems like this dynamic is expected to continue for a while. We had JP Morgan analyst Natasha Kaneva saying that the weaker supply and stable demand will tighten the copper market in 2026. So that's pushing up prices, and that's obviously good for the miners that deal in copper. So it's not just Capstone Copper, it's also Ivanhoe Mines, which you also named in the market movers, and Aero Copper and others. So it was just one of those copper kind of days, Marella.
All right. Yep. A lot of miners on the move today. All right. Bloomberg, Stephanie Hughes, appreciate that update. Coming up next, the odds of a Fed rate cut have lifted with major American markets up today. And also a new jobs report, payroll report from ADP. We'll get into the details in a moment. Payroll processor ADP reporting job losses over 30,000 in the U.S. Let's dig into this with Michael Kantrowitz, Chief Investment Strategist at Piper Sandler. Thanks for joining us today.
Hi, pleasure to be here.
So typically, I know the ADP numbers are different from the official data, which won't be issued until mid-December. How much weight do you put into the job loss number they went with today?
I think that data is reliable, just because it hasn't always corroborated the payrolls data that the government produces doesn't mean it's better or necessarily worse. So I think it's certainly been more reliable. There's more details there, and it's another data point of many jobs data points that we have seen soften over the past year and a half.
Okay, it would support then a December rate cut. Do you believe that'll happen?
I do. Yeah, I think that cements it. We'll get one more data point for employment on the 6th. We'll get the job openings labor turnover survey, or better known as JOLTS. I expect that to continue to soften as well. So, yeah, I think it is more or less a done deal that the Fed's going to cut. And certainly the market's pricing that in, and the Fed doesn't want to surprise the market.
Where else are you seeing the weakness?
I'd say generally, we look at PMI surveys of employment data, and the manufacturing employment data has been weak. It's been fairly broad-based. Healthcare and education they've been the only two sectors that have been steady and have been holding up, which is pretty typical. You don't go into recessions, or you don't go into, you typically don't see weaknesses in those parts of the job space. But I think that importantly from the ADP report, what was clear and has been clear for the last 6 months is that the weakness is coming from smaller companies. And that aligns with the earnings for smaller companies that, looking backwards, have been weaker. So to me, it's really just a lagged result of profit weakness over the last couple of years. It probably persists into 2026, but we don't see unemployment rising up high enough to cause a broader-based economic contraction.
When you see the weakness in the smaller companies, is that usually an indicator of what's going to happen for the mid-sized companies?
Sometimes, but I think we have to be really careful. There's only 10 recessions back to 1950, so we can't really assume anything is normal. I guess the answer to your question would be yes, but we are in a bifurcated, or what is better referred to as a K-shaped economy, and I think what investors have learned, or hopefully have learned over the last few years, is in a K-shaped backdrop, you got to be really careful of taking a data point from either side of the K, something strong or something weak, and applying it to the entire economy, or for the entire market. So I think, again, it's a reflection of the fact that smaller companies have struggled with high prices, high interest rates, and hopefully that's going to continue to heal into 2026 and things start to turn around.
You believe, despite sort of valuation concerns, markets can go higher. Tell me why.
Well, earnings, and actually year to date for the S&P 500, it's not been a multiple-driven market. It's been really almost 95% of the gain this year has come from rising earnings expectations, and that's a big change from the last couple of years, where it was really multiple expansion and just AI earnings driving things. So we've started to see the earnings expectations data broaden out. Even small and mid cap earnings estimates have been moving higher for the first time in a few years. So I think valuations reflect the current macro backdrop where we're getting some softness, but we're also getting some rate cuts. Inflation remains low. Yes, we still have an affordability problem, but inflation, the change in prices, is not concerning to me. And oil prices are low. So the concern really around valuation would be if we saw interest rates or inflation data spike, or if the unemployment data were to more broadly deteriorate. And we don't expect that in 2026.
All right. So what are your strategies for 2026?
Yeah, so we think we're going to see a year of value leadership and broader market participation into 2026. We're expecting to see improving housing data. Yeah, that's right. You heard me. Housing data in the United States. We're starting to already see some green shoots there in purchase applications, which are sitting at the highest levels in 3 years today. We also expect manufacturing activity to start to improve and move back into expansion for the first time in 3 years. And all of this is coming about because, ironically, of the labor market that's been soft, which has provided for lower rates on both the long end mortgage rates and the short end, the Fed funds rate. And that is what typically leads to a broadening of the economy. And now that we've had a year and a half or so of lower rates, we're finally beginning to see our indicators suggest that that data starts to broaden out and get a little better.
Okay, so are you remaining in tech if you are in tech now?
Yeah, I think the secular story in tech remains quite strong. I think where the alpha or outperformance is going to come from, though, is going to be outside of tech. So I would, it's tech. I still think, again, the secular story is quite strong, and we don't expect a big rotation out of tech. But what's going to change at the margin is other areas of the economy that have been lagging for the last few years. We expect to see some incremental improvement there, and that's where investors are going to find the combination of low expectations and positive earnings surprises more frequently in 2026 rather than just seeing continued AI earnings dominance.
All right, Michael, I do have to leave it there. Thank you for your time. Michael is Chief Investment Strategist at Piper Sandler. Shares of Enbridge are trading mixed today, despite the company announcing a 3% dividend increase. We'll dig into the numbers when we come back. Enbridge forecasting higher core profit for 2026 and has raised its dividend as the Calgary-based energy delivery company is in pole position to capitalize on growing demand for liquefied natural gas. Let's go to Aaron McNeil. He's research analyst at TD Cowen, and he joins us now. Thanks for your time.
Hey, Marella. Thanks for having me on.
So Enbridge's forecast is actually below TD estimates. Where's the biggest miss, and what do you see as a disconnect here?
Yeah, so just a bit of nuance here. It is below our estimate on an EBITDA basis. We were right in line on a DCF basis or distributable cash flow basis. So, in terms of the money that they earn that goes towards the dividend or goes towards growth capital, we were in line. Our FX assumption was a little higher than their guide. Our expectations on a recovery in their mid-con pipelines were a little bit higher. And a couple other bits and bobs, but ultimately, from a distributable cash flow basis, they were relatively in line with our estimate.
All right. There are, according to the CEO, $8 billion in new projects entering service in 2026. Can you give us some insight on what that includes?
Yeah, there's a whole thing across a whole slate of projects across the platform. What I would say is they're sort of firing on all cylinders. They would have projects coming to service in gas transmission on the oil side, renewables, et cetera. So, and on the utilities piece, there's this sort of wedge of recurring spend there. So it really, I mean, for a company of Enbridge's size, it's hard to pinpoint things, but they would have, quite a bit coming in across the platform.
Is a lot of this to cater to U.S. power demand?
Yes. Yeah. Most of the gas growth that we're seeing with Enbridge and with others is in south of the border.
All right. Has the company positioned itself to benefit at all from AI data center build out or needs in the U.S. or in Canada?
Yeah, it would be more of a U.S. phenomenon. Obviously, they're with the Spectra acquisition in, I believe, 2017, they added a big gas platform to the business. They also acquired 3 U.S. utilities several years ago, and they would sort of have tentacles into those types of projects across their platform. Ultimately, they're not going to be building gas-fired power. Their, pathway to that market is mostly through building laterals to new gas plants.
We also, of course, have a memorandum of understanding between Alberta and Ottawa. New pipelines could be in play. Will this benefit Enbridge at all? We know that Ottawa is looking for private money to invest here. We haven't heard about private partners yet. But what do you expect, or how do you expect Enbridge to play into this?
Yeah, so first of all, Enbridge is not the proponent, at least not yet. While they would be very capable of building this type of asset, they have not put their hand up to build it at this time. And in fact, they've proposed several other expansions to their mainline, which would expand crude oil midstream egress into the U.S. For incremental volume growth. And so, today they're actually offering brownfield expansions to their existing assets, which are largely oriented south, not west. And, that they believe, and certainly the math would bear it out, that, those are more capital efficient projects to expand egress today. And so I think ultimately for Enbridge specifically, the risk reward, isn't there yet. I would say that of Enbridge and others as well. But to the extent that there was a new pipeline built, obviously that would be a competitor to the mainline, which is the largest crude oil egress pipeline out of Canada today.
You mentioned that it's not enough has changed yet for a company like Enbridge to get involved. What would it take? Because obviously Alberta seems very on board with doing what it can to bring a new pipeline about. Ottawa now seems on board to make it happen, to fast track it if there is interest. What do you think it would take to cross that line?
Yeah, and I certainly don't want to speak for Enbridge, but I can provide my opinion. Like the last 2 West Coast pipelines, one being a gas pipeline, the other being an oil pipeline, were both significantly above original cost expectations. The returns on those assets will not be originally as expected. Today, Enbridge enjoys like a lot of opportunity across its platform in gas and oil, less so in renewables. And so this really becomes an opportunity cost discussion. And so, if they're enjoying high returns and other, opportunities, and they can fill their growth requirements with those other, lower risk capital light opportunities, it would be a tough sell to sort of convince them to sort of abandon that and go for a longer cycle, probably lower return, higher risk project. And so, while I don't want to propose solutions here, ultimately the risk reward balance would have to change. Like the government could come in and backstop a specific return. Like that's one example. There are several others, but I think giving more certainty on returns, because today Enbridge does enjoy kind of high certainty to pretty attractive returns across its platform.
Got it. All right. Aaron, I appreciate you joining us. Aaron McNeil, research analyst, TD Cowen today.
You bet.
Coming up next, Salesforce reported their third quarter earnings. More of that in a moment. Here are the stories we are following in the newsroom. Data from StatsCan shows productivity rose 0.9% in the latest quarter, following a decline in the previous one. Manufacturing, mining, and energy were the main sectors for the gain, while agriculture, forestry, and fishing recorded the largest decline, almost 6%. The total number of hours worked also declined. TELUS plans to pause its dividend growth while continuing to pay its quarterly dividend at the most recent level. TELUS says the pause will remain until its share price reflects growth prospects. The Vancouver-based company also announced a new 3-year free cash flow growth target of 10%. Enbridge increasing its dividend by 3% and affirmed its 2026 growth outlook. The Calgary-based pipeline operator says it has $8 billion worth of projects entering service next year, and it expects strong growth from recent rate settlements and cases in gas distribution and transmission. Last month, the energy company approved a $1.4 billion expansion to boost deliveries of heavy oil. Ivanhoe Mines has announced its copper production guidance for the Kamoa-Kakula complex for 2026 and 2027. The mining company now expects output at the site of up to 420,000 tons next year and up to 540,000 tons for 2027. Mining rates are also expected to improve gradually through 2026. We have third quarter earnings results from Salesforce coming into the newsroom. Let's go through a few of them. Adjusted earnings per share coming in at $3.25 versus $2.41 a year ago. The estimate had been for $2.86, so a big beat for the company there. Revenue coming in at $10.26 billion. That's an 8.6% increase year over year, and slightly below the estimate of $10.28 billion. A number of different revenue metrics also coming in. We'll talk about that in a moment. Let's get to the fourth quarter forecast. Revenue they expect of $11.13 billion to $11.23 billion. The estimate sits at 10.91, Bloomberg consensus. And they see adjusted earnings per share coming in at $3.02 to $3.04. The estimate is in the middle at $3.03. Also a 2026 year forecast. Revenue coming in at $41.45 billion to $41.55 billion. The estimate is on the lower side at $41.25 billion. All right, let's break this down with Patrick Walravens. He's Director of Technology Research at Citizens JMP. Thanks for joining us today.
Thank you for having me, Marilla.
What's the key metric for you here?
I mean, you want to see growth accelerate, right? And so just setting the table a little bit, it's been a brutal year for Salesforce investors. The stock's down nearly 30%. And when I checked just a moment ago before coming on, it was up 5% or so in the aftermarket. And basically what you're seeing is this company has made a massive pivot and investment in a product called Agentforce. And we are finally seeing signs that that is really working. And you were just going through the numbers. You know, the most important one was talking about the revenue guidance for next quarter, where they're talking about 11 to 12% growth next quarter, up from 9% this quarter. So you can see things starting to work and the business starting to accelerate.
Okay, let's talk a little bit about what has dragged shares down this year. I think much of it has to do with the concern that the business model doesn't have a lot of growth if AI bites into that business. Do you see that as a significant threat, or has the company sort of voiced a defense of that?
They've done a nice job responding to it. So the bear case on this entire space has been that AI is going to eat software, AI is going to eat SaaS. And what Mark Benioff has done, and this is one of the advantages of, you know, being a founder of a business that you've run for 26 years, is he refocused the entire business on their own AI product, which is called Agentforce. And this quarter, they just told you that Agentforce is now north of a $500 million ARR, which is annualized recurring revenue. So is it, you know, north of a $500 million business, and it grew over 300%. So that product is starting to really kick in, and as it becomes a bigger and bigger piece of the pie, it should help accelerate the total revenue growth.
Okay, so he definitely has countered with his own argument, but it doesn't look like investors are buying it. Why do you think that is?
I think they're starting to buy it, right? The aftermarket says they're starting to buy it, but you're right, the stock's really inexpensive, and the issue is that there are so many concerns that models, whether it's from OpenAI or from Google or from Anthropic, are going to replace the kinds of functions that companies like Salesforce and ServiceNow previously did in the enterprise. And I think what we're starting to see is that, in fact, in order for these models to really do the job you want them to do, they need a lot of scaffolding around them, and they need a lot of controls, and they need access to the right data. And companies like Salesforce are really well positioned to provide that scaffolding so the models can be more effective.
Okay. Salesforce also announcing layoffs recently, several hundred jobs. Do you think that is a trend that will continue with this company? It says it's basically gaining from AI efficiency.
Yeah, so yes, but then the second big point in terms of what's happening on this earnings call is they just acquired a company called Informatica, right? So they just increased their headcount by quite a bit because they're bringing all those employees on board. And that deal closed last week. What Informatica does is it has thousands of different connectors to data sources. And when you connect agents to the right data, they can do their job a lot better.
You maintain an outperform for the stock. Is that your continued outlook for the end of the year into 2026?
Yeah, we think this stock can go up a lot. We think this stock can go up to, over $400. It has been really beaten up. And if they continue to show this kind of growth with the Agentforce product, it should be a really nice outcome over the next couple of years.
Okay. I do have to leave it there, but appreciate your time. Patrick Walraven, Director of Technology Research, Citizens JMP. Thanks for joining us. Up next, Toronto's home sales dropped about 16% from last year. We'll talk about the numbers when we come back. Toronto home sales continue to decline in November, falling almost 16% from the same period last year. Let's talk about the housing market in the Greater Toronto Area with John Pasalis, president of Realos Realty. Thanks for joining us today.
Thanks for having me.
So rates are down, inventory's up. What is holding buyers back?
Well, there's a lot of uncertainty still in the economy. A lot of buyers are anxious. And part of it is they're worried that prices might actually be lower. So if you're worried that prices might actually fall, a lot of times you just sit on the sidelines and wait to see what happens. And that's really where we're at right now. Sales are going to end the year pretty much at a 25-year low. So people who are buying pretty much need to buy, and a lot of other buyers are just basically waiting to see what happens.
Okay, so we had a lot of uncertainty at the start of the year with the threats of the tariffs and the implementation of the tariffs. The trade deal has not yet been cleared. Are people then still worried about their jobs? Is that what you're getting?
Yeah, absolutely. They're worried about their jobs. The market started very bullish at the start of the year. People thought prices were going to rise in the spring. But certainly a lot of the uncertainty due to the trade war pushed people to the sidelines. They're worried about their jobs. They're worried about the economy. And they're worried prices might fall further. So a lot of this is a lot of the factors that are impacting buyers right now is just all of this uncertainty all around. And when you're anxious about the economy, anxious about your job, you're not rushing in to buy a home. And that's what we're seeing right now.
Okay, so let's dig into some of the details. Are we seeing, for example, newly built home selling versus resales? Are there better opportunities for buyers there?
Well, newly built homes, pre-construction sales have fallen off a cliff, whether we're looking at the condominium market or the low-rise market. They're pretty much non-existent. This is certainly one of the concerns that we're not going to have a lot of new housing starts. And those aren't moving because unlike the resale market where prices adjust to today's market, builders can't just lower their price 25% because their projects no longer become economically feasible. So the new construction housing market has basically stalled. All of the declines and the softening we're seeing right now is in the resale market.
Okay, let's talk about the housing outlook for the Greater Toronto Area, what we refer to as the GTA. What does that look like to you for 2026?
I mean, it's probably not bullish. I think a lot of people are hoping the market is going to rebound. I think it's probably going to remain sluggish in the first half of next year. The second half, of course, is going to be anyone's guess. I mean, and a lot of it is going to depend on what happens with trade with the United States. Do we have a little bit more uncertainty? And is the economy stabilize, or are we going to start hearing about job losses? So a lot's going to depend on the economy and the market sentiment in the second half of this year. But the best case scenario is that we get out of this period of falling home prices and see prices stabilize in the second half.
You mentioned that those who are buying are those who need to buy. Are you hearing or seeing a lot of first-time buyers still, or are they still on the sidelines as well?
Yeah, definitely we're seeing some first-time buyers. Some first-time buyers who are starting a life with a partner together. They want a home. They're having a child. Many of them are still buying a home. Some people are not as concerned about their jobs. They're not as concerned about timing the market. If they're looking for a low-rise home, a semi or detached, those are down 8 to 9% year over year. So they're finding that they can afford to buy a home in places that weren't possible a year ago. So some buyers are seeing this as an opportunity. They realize that prices may dip a little bit, but they're not trying to time the market.
Also wondering, John, whether or not you're seeing the trends that apply within the city of Toronto are the same that are in the extended areas of Toronto.
I would say the outer suburbs are certainly more sluggish. And this is really a product of the fact that they were also saw the biggest increase during COVID. If we think about the areas that saw the most rapid acceleration in prices, I mean, the further you were from the downtown core, the more rapid your price increase. And as the market's adjusting, those areas are certainly more sluggish, whereas urban homes tend to be selling a little bit better and a little bit more quickly.
All right, John Pasalis, going to leave it there, sir, but thanks for your time. I appreciate it.
Thanks for having me.
CTV News is speaking with workers at Algoma Steel and getting their reaction to the announcement of the layoffs there, saying Trump's tariff shock forced the layoffs. We have CTV's Scott Hurst with more on that.
The company and many of its workers are placing the blame on why the cuts are happening now squarely on U.S. President Donald Trump's punishing 50% tariffs on Canadian steel, an impact effectively closing off the plant's #1 customer. So in an effort to stem the losses, Algoma says the current punishing financial picture right now is forcing its hand to accelerate retooling plans. I believe we have a clip from the CEO. Let's listen to that, and I can talk more about the transformation that is happening at Algoma Steel.
I think the government certainly knows our business strategy. It knows the pivot that we had to make. It knew very well that the extreme pressure the company was under. I don't think anybody would loan the company $500 million without asking very detailed questions about what our business plan was. I think the core concern is how do we protect the ongoing Algoma Steel? How do we make sure this company is competitive, is viable? What's the technology you're going to use? How are you going to make steel? And the jobs associated with that are an output of that.
So, Andrew, in terms of this transformation, it was something, according to the CEO, that was announced in 2021 to a new modern steel-making process and platform that does require a smaller workforce, a process that is less labor-intensive. So, according to the CEO of Algoma Steel, the plant was expecting that transition to happen sometime in 2027, but with the U.S. tariffs, those plans had to be accelerated, calling it an early pivot, really saying with so few orders right now, the company had to begin the transition, and the job losses are part of that restructuring, but brought on by the punishing tariffs, with the CEO, as you heard, saying right there, Ottawa, the federal government was aware of this plan when it loaned Algoma more than $500 million earlier this year, Andrew.
CTV News has spoken with some of the workers in Sault Ste. Marie. What are they saying?
Yeah, workers, of course, right now are dealing with the initial shock. They're still reeling. Of course, it is devastating for anyone to get the notice that your job is being eliminated, and these jobs will be eliminated early next year in March. And in an interview with CTV News, union heads are saying their members are obviously upset and concerned about the ongoing layoffs. And the steelworkers, they say, had negotiated a mitigation strategy through the process to help workers transition with the focus notably on job retraining. But now it says workers are being let go in March without that strategy being implemented. So, of course, these cuts will have a profound impact on the company, but also the region as a whole. 1,000 job losses, by far the largest employer in the region in Sault Ste. Marie. So the impact of these job losses cannot be overstated, incredibly significant. Well, these job losses, as we mentioned, were inevitable with this retooling plan. It is years ahead of schedule, Andrew, and of course, it doesn't make it any easier.
CTV's Scott Hurst reporting there. The OpenAI CEO Sam Altman has issued a code red for ChatGPT. We'll tell you what that means when we come back. Sam Altman is calling a code red for ChatGPT. The OpenAI exec wants employees to focus on the chatbot and speed up its evolution. Let's talk about that with Doug Clinton, founder and CEO, Intelligent Alpha. Thanks for joining us today.
Thanks, Marilla. Good to be with you.
What are the shortcomings of ChatGPT when stacked up against the others?
You know, I don't know that it's so much about shortcomings as it is that we have these, these very small and albeit brief leads with new model releases that these companies are pushing at faster and faster paces. And so we had Google put Gemini 3 out just a month ago. After that, Anthropic came out with their newest model just recently, Opus 4.5. And if you look at these benchmarks, which basically are sort of like tests that we use, technical tests we use to stack rank the models. Every time a new model comes out, benchmark numbers go up. And so ChatGPT is now third in the race, if you look at the benchmarks. They're working on a new model called Garlic. That's the code name internally, and it'll probably launch in the next several weeks, maybe early next year. I think that will probably put them back at the top of those ranks. But the code red is really to get them, I think, to figure out what can we do to break out and try to get our distribution edge above Google, because I think that's where they're going to really have a lot of challenges.
Yeah, they're at about 800 million users, something like that. But part of the problem, and tell me how much of a problem it is they don't make any money. So why haven't they, for example, introduced ads?
The thing about emerging technologies, I think it's really important for everybody to understand, is that we get bubbles because it actually serves a purpose to sort of discount the technology or subsidize the technology for users. So we get those 800 million weekly active users on a ChatGPT. So to your point, they're not making money on the bottom line. They're generating about 20 billion or so on top line run rate revenue. So they are getting a lot of top line revenue. But I would say that they've had a lot of this investment to just make sure that consumers can access this technology, whether it's for free or through a cheap paid subscription right now. And so I think that over time, what we'll see is those prices, those subscription prices, will ultimately go up, because I think OpenAI and Google, as a byproduct, they do have a lot of pricing power. Once you get sort of addicted to using these tools, you really can't get away from them. So I think they will be profitable in the long run.
All right. So why do you think we're seeing the kind of volatility in the AI stocks we've seen in the last few months?
I think a lot of it has a simple explanation, which is the trade was just getting sort of tired. And that's the reality of many of these bull runs. If you look back at the dot-com era, it lasted about 7 years. Over that time period, there were 10% pullbacks on the NASDAQ. And so we actually didn't even get the 10% pullback in this most recent volatility bout. We've only had 2 periods of 10% pullbacks since the AI bull market started at the end of 2022. So I think what we were seeing was really just sort of a normal course of action where the trade gets heated, the market sort of needs to digest, some of the heat comes off the trade. And my sense is we might have maybe another couple of weeks of digestion, but I do suspect that next year the AI trade will continue to work.
Okay, and you believe we have 2 to 4 years left, bigger picture in AI, so what comes next?
I think there's 2 big themes going into next year, Morella. One is going to be distribution. So when we talk about what's kind of the next leg of the OpenAI versus Google race, it will be about distribution. Who can get these products out front, in front of customers, embedded in their everyday lives. I do think Google has an advantage there. It's a stock that we own at Intelligent Alpha in our long short fund, where we use AI to actually pick all of our stocks. And so I think Google does have that distribution advantage with 4 billion daily active users. The other big theme going into next year for AI is powering data centers. And so last year, really the last 18 months, I think the big bottleneck story has been around chips. It's been around NVIDIA and can we get access to GPUs? Now the bottleneck has really reverted to power. Can we get power to the data centers we're building? All of this infrastructure we're looking into empowering. And so I think companies like a Vistra, a First Solar, some of these derivative plays on power are interesting into next year as data center builders figure out how do we actually get juice to all the GPUs that we're putting in the building.
And you think that the need will be so great they'll move to different sources of power and away from the general?
I do. I think that it will be actually a multifaceted approach. I think we'll see things that are off-grid solutions. So we've seen a lot of this sort of investment in jet turbine engines, for example, through companies like GE Vernova. We've also seen these sort of independent power producer agreements. Companies like Vistra have done deals with the Amazons, the Microsofts of the world. We're bringing back online 3 Mile Island nuclear plant. And so I think we're going to see many different approaches. I do think that solar has been one approach. I mentioned First Solar a little while ago. That's one we really haven't seen take off yet. I actually think that could be more in the playbook next year. And I think First Solar is potentially a great way to play that, trading at a relatively cheap multiple.
All right, Doug, I do have to leave it there. I'm out of time, but thanks for your time.
Thanks, Marilla.
Doug Clinton, founder, CEO, Intelligent Alpha. Time now for Hot Picks. We dove into some packaged food and beverage stocks with Jim Solera, research analyst, institutional equities and research at Stephens. He talked about how he's bearish on sugar-free and energy drink companies. And we kick things off with Celsius, one of his top picks.
Celsius is positioned in a very unique space in the U.S. right now, because what we've seen is a big consumer migration towards this focus on cleaner label, better ingredients, zero or low sugar products. And we've also seen a migration to energy drink as kind of a preferred caffeine delivery source, especially for younger consumers. And so earlier this year, Celsius acquired a brand called Alani Nu, which is more of a female-centric brand, paired with its core Celsius brand, and then recently also picked up the Rockstar Energy brand. And so they have a pretty targeted portfolio that really expands the aperture of consumers that will come into the energy category. And we've been seeing them really drive incremental visits and incremental trips to the energy category because of the zero sugar kind of health forward brand positioning.
Tell us about your next one, Vita Coco. The core of their business is coconut water, and that striking a chord with consumers?
Yeah, so again, kind of pulling on that same thread around health and wellness, Vita Coco, organic product, pretty much as natural as you can get. Crack the coconut open and water comes out, and that's the product that you're consuming. Earlier in the year, there were some concerns around tariff impacts and what that might do to the business. But as we've seen recently, the Trump administration has put in exemptions for a lot of food products, coconut water being among those. And so that's dramatically improved the margin profile for the business moving forward. And we've also seen, major retailers like Walmart increasing their shelf placement for better for you beverages, including coconut water and Vita Coco in specific. And so when you have large retailers increasing the shelf visibility, that drives more eyeballs and gets more consumers to try the product and, add it into their kind of routine shopping behavior.
Apparently, there has been a lot of hype about coconut water, but it's not bad for you, but it's not especially good for you. I don't know if it's particularly nutritious either.
I think it depends on what you're substituting. So what's the use occasion?
Right.
So, if you think about coconut water as kind of a natural hydration beverage versus, a sugary sports drink or something like that, it does reduce the amount of sugar, and particularly you're substituting natural sugars versus artificial sugars. So like all things, it's a comparison of what you're replacing versus what you were consuming before.
So you say, I think you touched on this, you reckon the valuation is rich, but you think it's justified in this case with Vita Coco?
Yeah, so I think right now in consumer, given a lot of the dynamic around kind of lower income consumer pressure in the US, there's not a ton of growth opportunity. And so what we found is all of the brands, so we touched on Celsius earlier, Vita Coco, another one, if they're in this momentum basket and they're seeing more engagement with consumer, potentially replacing legacy brands that the consumer was previously buying, that allows them to command a much more premium multiple relative to the rest of the group. So it's a small selection, but we think that, if you're in that momentum basket, it allows you to command a premium versus, kind of the broader group.
I notice if I go into a corner store or a convenience store, there's a fridge and it's just full of beverages from the giants, Coca-Cola and Pepsi. I think they supply the fridge in some cases. So is it hard for these smaller brands to get into an outlet like that?
Yeah, so that's a great point. And yeah, Coca-Cola and Pepsi, as long as KDP, Keurig Dr. Pepper, have big direct store distribution networks where they have employees, going to these convenience stores and other outlets and filling these refrigerators. Celsius actually has a distribution agreement with Pepsi. And so that allows them to kind of piggyback off of that much larger network. And so you'll often see Celsius in those branded Pepsi coolers alongside, other Pepsi products. And so it provides a kind of insulation for a brand like Celsius, and does create a challenge for some of the smaller energy brands to really get that same kind of on-shelf presence if you're not riding with one of the big distributors.
And then finally, Zevia, which uses that sweetener stevia, or stevia, I forget how to pronounce it. Tell us, again, this feeds into the thesis that consumers want stuff they see as healthier.
Yeah, so again, kind of common theme across all these guys. Zevia is zero sugar soda, really priced at a much more affordable price point versus what we've seen from some of these other kind of functional, better for you soda. It's much more comparable with kind of a traditional diet soda in terms of price point. They actually just signed a deal to expand into Walmart Canada. So if you have any viewers that are shoppers at Walmart, they should see this appearing on shelf in the not too distant future. But again, we've seen a lot of retailers, Walmart in particular, take a leadership role in expanding the shelf presence for these zero sugar beverages. And in our view, that's kind of an indication of things to come. If you have the world's largest retailer adding more allocation for these zero sugar beverages, I think it speaks to kind of the durability and in the long-term trend that we see with consumers, guiding towards these healthier options.
Jim Solera with Stephens. Here is how we ended the day in Wall Street. Just a recap of that data. The TSX closed up today 111 points, about 0.4%, ending the day at 31,160. The S&P 500 gained 20 points today. The Nasdaq moved up 40 points to end the day at 23,454. A quick look at Salesforce, which did report earnings after hours today. This is their third quarter earnings. You can see the stock, investors seem to like it. After hours, it's moved up 4.75% to 250.07. A couple of things. The company gave an outlook for revenue in the current period that did top analyst estimates, suggesting the software company is persuading customers to buy its AI tools. There had been concern, of course, that the company, which has Salesforce platforms, software platforms, that business would be eaten up by AI. But clearly, the company's still doing well. That does it for the close today. Thanks for joining us. We'll see you back here tomorrow.